Welcome to the deep dive. Today, we're really zeroing in on something central to Warren Buffett's incredible success: prudence.
Hmm.
And it's not just being careful, is it? It's more like a disciplined, rational, very long-term approach.
Exactly. A consistent mindset.
We've pulled together insights on, I think, 7 key ways this prudence shaped his entire career. And, for anyone building a business, the lessons here are just invaluable.
Yeah, understanding how he applied that thinking, that discipline, it really gives entrepreneurs an edge, doesn't it? Especially for like long-term planning and navigating tough decisions.
Totally. It's more than just stock picks, it's foundational.
It really is.
So in this deep dive, we'll trace these 7 strands. We'll start with his early life, then move to the partnership era and value investing,
Uh-huh.
how he handled Berkshire's capital, the qualitative side of his investment choices, dealing with market swings,
By the volatility aspects.
his unique view on risk management, and even how prudence shows up in his personal life and philanthropy.
Covers a lot of ground.
Okay, so let's start at the beginning, that foundational prudence.
Yeah, and it's amazing how early it started. This wasn't something he just picked up later. It seems like it was there from, well, very young.
Oh, absolutely. Even as a kid, right? This intense interest in business, in numbers, he was apparently just devouring books on securities.
Hmm.
And he preferred, actually doing business rather than just focusing solely on college classes. Get this, he filed his first tax return when he was 13.
13.
Yeah.
That's something else.
Right. What were you doing at 13?
Definitely not filing tax returns. But look at the benefits of that early start. He apparently saved up a good amount by the time he even got to college.
Wow.
And think about the learning from those early ventures. Buying stocks at 11, the pinball machines. That's real hands-on experience with business, with cash flow.
He wasn't just playing around.
No, not at all. And he seemed to grasp the power of compounding really early on, almost intuitively.
Yeah, and it wasn't just like pocket money ventures either. He had a proper business mindset. That tax return thing shows incredible attention to detail for a kid.
Mm-hmm.
And buying farmland at 14, that's thinking long-term asset ownership, not just a quick flip.
Right. While his peers, his competitors, if you like, were maybe on a more traditional school path without that practical side.
Or maybe even stockbrokers who didn't have that deep business sense he was already building.
So the lesson there for entrepreneurs listening is pretty clear, isn't it? Start early. Be persistent.
Yeah.
Don't be afraid to make mistakes and learn from them. Build that work ethic, that attention to detail. It's foundational.
Okay, so from that early foundation, he then actively sought out deeper knowledge. Which brings us to the Buffett partnership era.
Right, and his focus on value investing.
This is where things really kick into high gear.
Yeah, this period was crucial. His interest led him straight to Benjamin Graham.
The father of value investing.
Exactly. And Buffett was so keen to learn, he famously offered to work for Graham for free.
Incredible dedication.
Then he goes back home to Omaha, starts his own partnership, shows real conviction, right? And he kept working at it, always expanding the partnerships.
And the results, pretty stunning.
Oh, yeah. Extremely successful investments. He became a millionaire by, 1962?
Yeah, early 60s. This is really when that Oracle of Omaha nickname started to stick.
And the prudence here, it was all about sticking rigidly to Graham's principles.
Value investing 101.
Right. Buying companies for less than they're truly worth that intrinsic value, finding that margin of safety and taking a really long-term view, not worrying about the daily stock price swings. Plus, pooling partner capital let him make bigger bets with less personal risk spread out.
So his approach was totally different from, say, the typical Wall Street firms back then.
Oh, completely. They were often focused on short-term gains, chasing trends, speculators just looking for a quick profit. Buffett was playing a different game entirely.
So for entrepreneurs, what's the parallel? Actively seeking mentors, finding frameworks.
Definitely. Find the wisdom, find the frameworks that fit your goals, like value investing fit Buffett's, and then crucially, stick with it. Persist in finding opportunities that match your strategy. Don't get sidetracked.
That persistence led him to the next major step, taking control of Berkshire Hathaway.
Ah, yes, the textile mill.
Which then became the vehicle for everything else. And this is where his prudence in capital allocation really shines.
It really does. And what's interesting is how much he seemed to genuinely enjoy running the businesses within Berkshire.
Yeah, he saw owning stock as owning a piece of the actual business. Famously said he'd be happy if the stock exchange closed for years.
That's a true owner's mindset, isn't it? Not just a stock market player. And he's still chairman, still deeply involved.
And look at the outcome. Transforming that struggling mill into this huge, successful holding company, acquiring all sorts of businesses, generating massive returns for shareholders over decades.
His capital allocation rules are, well, remarkably prudent. He only reinvests earnings if he's confident they'll boost the per-share value proportionally.
Very disciplined.
Extremely. Very cautious about debt. Avoids excessive financing. He'll only issue Berkshire stock if he feels he's getting equal value back.
And the structure itself. Diverse businesses, but capital decisions made centrally.
Exactly. Decentralized operations, centralized capital allocation. It's quite genius.
So unlike companies maybe relying too heavily on debt,
Right. Or companies stuck in rigid management theories, not valuing the actual people running the subsidiaries.
so the lesson for entrepreneurs, even smaller ones, think hard about where your money goes.
Absolutely. Smart capital allocation is key at any scale. Always focus on creating long-term value. Maybe even consider a holding structure if you diversify.
And always think like an owner.
That's the core of it.
Okay, so beyond the structure and the numbers, let's talk about the types of businesses he picks, those qualitative factors. That's our fourth point.
Right. And you get the sense he genuinely enjoys the process of studying businesses. It's not just about spreadsheets for him.
No, he's looking for something deeper.
He's looking for companies with enormous durable competitive advantages, things that will last for a very long time. He sees investing as buying into understandable businesses with predictable, strong future earnings.
And that understanding is key. It famously helped him sidestep the dot-com bubble, right?
Exactly. He admitted he didn't understand those internet business models, so he stayed within his circle of competence.
Which saved him a fortune when it burst.
And it let him build this portfolio of businesses with real staying power.
So how does he apply that? What's he looking for?
Well, rigor is the word. He focuses intensely on industries he knows well. He wants companies where you can be pretty certain about long-term earnings growth.
So avoiding fast-changing tech, maybe, at least initially?
Right. He avoided those early on. He looks for companies that reinvest earnings wisely and, crucially, are run by honest, capable managers.
Like passing on Google and Amazon early on because he felt he didn't fully get the internet landscape back then.
Exactly. It wasn't about predicting the future winners perfectly. It was about sticking to what he understood deeply. Now, his portfolio reflects that consumer goods, finance, insurance, some tech he now understands better.
So the contrast is with investors chasing hot trends.
Yeah. Chasing hype without deep understanding. Speculators focused only on short-term pops, ignoring the actual business.
The lesson seems pretty stark. Know your turf.
Absolutely. Define your circle of competence and stick to it. Don't chase things you don't understand. Build your own business with a durable edge.
And value integrity and partners and management above almost everything else.
Non-negotiable.
Okay, but even with the best businesses, markets go crazy sometimes. Point 5. Buffett's prudence during volatility.
Yes. This is where his temperament really shines. He's remarkably calm when markets are tanking.
He actually sees downturns as opportunities.
Precisely. Opportunities to buy more of those great companies at bargain prices. He loves Ben Graham's Mr. Market analogy.
The irrational business partner.
Yeah, it helps detach emotionally from the market's manic swings. His core belief is just that time favors wonderful businesses.
And that calm approach has paid off massively. He used downturns to load up on companies like Geico, right?
Famously, yes. And by not panicking and selling low, he avoided huge losses. His whole career is built on that long-term compounding, which just isn't possible without patience through the dips.
His famous quote comes to mind. Be fearful when others are greedy.
And greedy when others are fearful. That sums it up perfectly. He actively looks for those moments of peak fear as buying chances.
And his holding period?
Ideally forever, as he says. He plans to own stocks for at least 10 years, often much longer. He tunes out the short-term noise. Advises against market timing.
He even suggests index funds for most people.
Right. Low-cost index funds held for the long term. A very prudent approach for the average investor.
So the opposite of the hyperactive trader.
Exactly. Or the person who sells everything in a panic. Or anyone trying to guess the market's next move.
The lesson for entrepreneurs seems to be about emotional discipline.
Definitely. Build resilience. Have a long-term plan and stick to it, even when things get rocky. See downturns or industry challenges as potential opportunities, maybe to gain share or innovate.
And just accept that real value takes time. Patience.
Patience is key.
All right, point 6. Prudence is fundamentally about risk management. But Buffett's definition of risk is different.
Very different from the standard view. He argues real risk isn't just price volatility, it's the chance of permanent capital loss.
And where does that come from?
From not knowing what you're doing, from making unforced errors based on a lack of understanding. So his passion is really about protecting capital, pragmatically. He often credits Graham for these ideas.
And this approach has obviously helped Berkshire deliver consistent returns.
Yes, by helping them avoid unnecessary losses and really catastrophic mistakes.
So how does he apply this risk management? We mentioned margin of safety.
That's the cornerstone. Buying assets for much less than you think they're worth. But also, his discipline about debt is huge. Avoiding excessive leverage.
Especially high interest debt.
Absolutely. And his investment approach itself is risk management, focusing deeply on a few great businesses he understands, rather than just spreading money thinly across lots of things he barely knows.
So concentration over blind diversification.
For him, yes, where his knowledge is deep. And he emphasizes learning from mistakes. Constantly refining strategy based on what went wrong is a critical risk tool.
Which contrasts with, say, defining risk just by beta or price swings.
Right, or financing things with high-risk debt. Or thinking just owning 100 different stocks automatically protects you if you don't understand them. He relies on analysis, not just gut feel.
Okay, the entrepreneurial takeaways on risk.
Prioritize avoiding permanent loss above everything. Always build in that margin of safety. Be incredibly careful with debt. Focus your energy where you have real knowledge.
And embrace mistakes as learning fuel.
Crucial. Don't bury them, learn from them.
Finally, point 7. This prudence extends beyond business, right, into his personal life and philosophy.
It really does. And it's quite compelling. He believes true success is about more than just money, finding meaning in what you do every day. He's not keen on creating, dynastic wealth.
And you see that reflected in his lifestyle.
Absolutely. Famously frugal, considering his wealth. It seems to stem from a belief that wealth is just a byproduct of good decisions, not a reason for extravagance.
And that modesty, that straightforwardness, it builds trust, integrity.
Definitely. I mean, he still lives in the same house he bought decades ago.
The one in Omaha.
Yeah. Simple habits, McDonald's, Coke, and then there's the philanthropy, the giving pledge, planning to give away almost all of it.
Which actually affects his ranking on the wealth list sometimes.
It does, because he's actively giving it away.
It's such a contrast to, well, defining success only by fame or accumulation.
Or being focused on building those financial dynasties, or using extravagant spending as a status symbol.
So lessons for entrepreneurs here. Define success more broadly.
Yes. What does it mean to you beyond the bank balance? Cultivate humility. Avoid getting caught up in excessive displays. Think intentionally about the impact of your wealth. Consider generosity.
And practice living within your means no matter what.
Fundamentally, yes.
So wrapping this up, Buffett's career is just this incredible long-term case study in prudence, in investing, business, risk, life.
It's that discipline, that long view, the focus on deep understanding and, strong moral compass underneath it all.
And the key point is these aren't just principles for billionaires.
Not at all. Entrepreneurs can absolutely use these ideas to build better, more sustainable, and maybe even more meaningful businesses and lives.
Well said. And next time, we're going to tackle another huge piece of the puzzle, Buffett's views on management and company culture, and how that shapes the unique way Berkshire Hathaway actually operates.
That'll be fascinating. Which leaves you, our listener, with maybe one final thought for this deep dive.
Yeah.
How could you take just one piece of Buffett's personal prudence, maybe his idea of success, or living simply, and integrate that into your own entrepreneurial path this week? Just something to reflect on.
Welcome to the deep dive. Today, we're really zeroing in on something central to Warren Buffett's incredible success, prudence. And it's not just being careful, is it? It's more like a disciplined, rational, very long-term approach.
Exactly. A consistent mindset.
We've pulled together insights on, I think, 7 key ways this prudence shaped his entire career. And, for anyone building a business, the lessons here are just invaluable.
Yeah, understanding how he applied that thinking, that discipline, it really gives entrepreneurs an edge, doesn't it? Especially for long-term planning and navigating tough decisions.
Totally. It's more than just stock picks. It's foundational.
It really is.
So in this deep dive, we'll trace these 7 strands. We'll start with his early life, then move to the partnership era and value investing, how he handled Berkshire's capital, the qualitative side of his investment choices, dealing with market swings,
By the volatility aspects.
his unique view on risk management, and even how prudence shows up in his personal life and philanthropy.
Covers a lot of ground.
Okay, so let's start at the beginning.